Good morning. Why the lowest rate is often the most expensive loan on the table. Most borrowers are trained to shop for one number, and we all think it the interest rate. Lower interest rate equals good, right? But sophisticated borrowers and real estate investors will understand something a little differently. And the lowest rate on paper can produce the highest total cost over the life of the loan. And as a mortgage broker and capital advisor at Medallion Funds, I regularly review loan estimates where the lowest rate option quietly contains significant points, prepayment penalties, and structural exit traps that cost tens of thousands more over the time of the loan. So let's break down where the hidden cost actually lives. First point, points versus lender credits, the rate illusion. So a lender can lower your interest rate, but rarely for free is the point. And discount points will lower your rate, and paying 1 to 2 points uh, usually reduces, say, about a percentage off your loan. And on a $750,000 loan, 2 points is $15,000 up front. And the real question is, will you hold the loan long enough to recover that cost? So if you're planning to refinance or sell or recapitalize in 3 to 5 years, you may never reach break even. So use lender credits as the point. The opposite structure increases the rate slightly, but provides a lender credit to offset your closing costs. So for borrowers who plan to refinance or reposition, or if they know they're going to sell in a short time frame, credits often outperform points as far as your total pocketbook expense. Strategy beats rate shopping is the point. Two is prepayment penalties, the silent wealth transfer. And many lowest rate loans, particularly with DSCR loans or commercial mortgages or any non QM investor loans, but also certain bank portfolio products when we're doing blanket loans, generally include prepayment penalties. And common structures can include a 3-2-1 step down, a 5-year step down, and you could also have yield maintenance or defeasance. Both of those are a little more tricky and can be substantially expensive. The point is, if rates fall and you refinance early, you could be trapped into one of those, and you could pay 25,000, you could pay 50,000, you could pay even six figures on larger deals. So let's think about it first. A lower coupon becomes irrelevant if exit flexibility is going to disappear. So sophisticated borrowers are going to price optionality and not just rate. So let's look at number three, exit cost and refinance traps. And the most expensive loans are often those that restrict your ability to exit the loan. So typically we see this where there's a balloon structure or a bridge loan. And then you'll have a 5-year balloon which has a low rate and it sounds attractive. But what if market rates rise at maturity? So then you're refinancing into a higher rate as well, which means you'll end up with a higher rate and potentially have stricter underwriting at that time and a lower valuation. And worst case scenarios, you're bringing additional equity into the equation. And there's a DSCR refi trap. So if you close at maximum leverage and rents soften, your debt service coverage ratio is not going to support refinancing later, even if rates improve, without you bringing additional money in. So that a low initial rate becomes a liquidity event later is the point. Four, the total cost of capital is better than your headline rate. So professional borrowers are going to evaluate a few other topics like APR, your annual percentage rate, your total interest paid, how you can amortize your points, any exit penalties or prepayment penalties, and prioritize flexibility and have refinance assumptions in mind. And really, you got to look at your liquidity as well. So the correct framework is cost of capital over your intended hold period, and not just the lowest rate today. Five, when a higher rate is actually smarter. And you could and may intentionally choose a slightly higher rate without a prepayment penalty or lower upfront point costs. That gives you stronger refinance flexibility. And what it does is that structure can protect your liquidity. It can reduce risk, and it can improve the internal rate of return by not having to pay points up front. But it also gives you the option to exit the loan early. So in many investor scenarios, that flexibility creates more long-term wealth than saving, say, 0.25% on your interest rate. And that's the bottom line. The lowest mortgage rate is often the most expensive loan because it hides cost in a few different categories. So it hides cost in points, in prepayment penalties. It can hinder your flexibility. You could have some exit risks or exit prepays. And smart borrowers don't chase rate is the point. They engineer the structure for the loan from the beginning. And if you want to review your loan options through a capital strategy lens and not just a rate sheet, connect with Medallion Funds today because structure is better than headline pricing. And that, my friends, is it for the day. Please visit BillRappOnline.com to figure out how to get a hold of me. Love to talk to you more about your specific scenario. Take care.